Here's this one strategy that always seems to occur for companies that are beaten down, the stock price is hammered. This one thing often happens, worth watching out for. Alright guys, so stocks like this is the prime example, and I've got another couple of examples for you. What you want the criteria to be is a company that is just struggling massively. So for example, the theme we've had of retail dying, or the theme we have of a specific business being absolutely hammered, you know, like a change in the way that consumers consume something, like they're moving to streaming or they're moving to online retail, that big trend change, and finding the companies that are going to get hit the hardest by that. So something like this Fossil, for example, struggling company, really not doing very well, and you know, wasn't in its heyday, was doing great valuation, then just starts to kind of lose money. Earnings are coming out very poor. You know, the golden rule generally of 3 bad earnings in a row. So you have 3 bad earnings in a row, 1, 2, 3. Reasonably good one here. But it just gets so beaten down that they get to a point where the brand is still the brand, right? They may not be making money, they may be struggling, but very often you get to the point where they've come so low from where they've been. So if you go back and you see like the highs of this, you're like, well, these, especially recent highs, you know, 130s, 140s, down now to, you know, $6, $5, whatever it may be. Difficult to judge, but the thing is, often if you get one piece of good news like this, obviously you're not going to second guess that, and if you're on that from whatever reason, then that's nice. But very often, this is the catalyst for some kind of recovery, because more often than not with these companies there is some lifeline, or there's some talk of a lifeline, or there's some turnaround, there's some last gasp of air before they finally go under, or it might be the recovery. So when you find a stock that's hammered so much, keep an eye out for the earnings dates, keep an eye out for catalysts, keep an eye out, put them on your gappers watch list, and so that when you see this kind of thing, you can then maybe buy a break above the high here and look to trail it. And the point is, look at the percentage move on this. You know, go from $18 to $30. Yes, finally it did roll over again. That tends to be what happens. They kind of roll over because this runs out of time. Maybe it's a debt lifeline, maybe it's some kind of deal, but it still doesn't change the fact that the company's struggling. Another one in the UK, which was a classic one, was Mothercare. You know, Mothercare, really struggling business. They used to be kind of the selling baby products and stuff to families, and the same kind of thing happened, right? They're literally struggling, and you get this constant. In fact, with Mothercare, there's multiple cycles of it, multiple cycles of you know, poor earnings, share splits, poor earnings, all this stuff. But even when you go down to here, this is the kind of point, guys. Look, you go down to here, you've had bad earnings, and then eventually you get this gap up. You know, so you get this gap up on earnings, which is here. And if you're buying the break of the gap on the next day, then you've got some room to move. And this is doubling. This is going from 15 to 25, 30. So, and we've had multiple times where this has happened. Now, this isn't, again, you can choose how to trade this yourself, but one thing you can do is you can say, and look, we've had this again here, you know, some kind of catalyst that's helped it, and from there, you know, gone from 12 to 17, so serious percentage moves. And nobody's watching these things because they all think it's dead, it's a dead duck, it's gone, there's nothing going on with it, and it may well be, but the point is, from a trading perspective, the opportunity to wait for the base, wait for it to be absolutely so out of favor and you think it's going to go bankrupt, and then to see a positive catalyst, and then to trade just a 4, 5, 6 day run off that positive catalyst can often be a really successful trade. Now, bearing in mind, there could be something negative come out. You could be unlucky in the stock that goes bust on you. But if it's low priced and you're sensible with your risk management, you're filtering for stocks that have come way off their 52-week highs, that are perhaps story of a trend change. Like I say, people not buying pushchairs, prams and stuff from retail outlets anymore. They're all buying them online. That's the big theme. That's why Mothercare is struggling. Still a solid brand though, still a brand that everyone recognizes. Earnings comes out, something happens that's a catalyst for a break. any shorts are long gone, and people think it might be, there's so much supply demand imbalance that you get often a 4 or 5 day move. So it's something worth watching, guys. It doesn't happen very often, of course. Obviously there's a risk perspective that you could get a horrible gap because you've got to hold these stocks overnight, but very often you see this pattern more often than not. So the pattern, just as a quick reminder, is the basing, big move off highs, sitting at lows, just struggling, then some kind of catalyst that makes it go up 20, 30% maybe, and then you're trading off that high looking for it to continue for 4 or 5 days.